everybody, and welcome back to FinTech Minute Take. My name is Mushir Ahmed, founder and MD of FinStep Asia, and an ex-trader who's going to be talking to you about short selling, GameStop, and about the war between Wall Street and social media traders. Now, let's start with short selling. Short selling is a concept in financial markets where a hedge fund or any other traders borrows a stock from a stock owner, and then they go and sell it in the market and try to make a quick profit because they expect the stock to do badly. The original stock owner is providing this lending to the funds because they believe in the longer term stock price, and then they're holding the stock for a longer term, right? All legal, all above board, very standard practice, and some expect that this is a part of the efficient market hypothesis, while hedge funds and day traders, etc., use that quite often to make quick profit. Now, GameStop is an American stock which is of a company that is into gaming. They have not been performing too well over the last few years, and they expect that they won't be doing too well over the coming couple of years. Interestingly, they announced new addition to their board, which includes the Chewy co-founder, Mr. Cohen, and there was a little bit of a bump on their share price earlier in Jan. Having said that, once that bump happened, you started seeing increased short selling. So you had a lot of short interest. Hedge funds started borrowing their stock, and they started selling their stock in the market. When news got around that GameStop was being sold and being shorted, a group of traders from a Reddit thread called WallStreetBets started getting into the action. They believed that GameStop was a good trade, or they believed that they wanted to go against the hedge funds whom they feel are distorting the market prices, etc., and buy the stock. So they started buying the stock. This Reddit thread has hundreds of thousands of users. Up until earlier this week had 3 million users, and now has 4 million users who discuss anything from stock market prices to different asset classes, their wins, their losses. Everything is shared by a whole bunch of people there. So not the traditional traders, not from funds, but day traders likely using apps like Robinhood, etc. So when these guys started buying the stock has skyrocketed, gone over 1,700% up. Late last year, earlier it was trading about $4. Now it had almost peaked to over $200, right? So a huge jump. As an side impact, as you see in markets, we saw this with Zoom earlier this year. A stock of a mining company in Australia also went up, which had a similar symbol, GME, in the Australian market, where some of the Australian traders others thought that it's the same stock and started buying it. Now, what happened with this is when people short the stock, they need to then go and buy back the stock from the market. So the hedge fund has to go and buy it back to return, because based on their terms, they expect to return, right? Now, if they're not able to buy back at the price that they sold, or within their losses, then they will clamor to buy it at whatever price possible so that they can minimize their losses. For this to happen, there need to be enough available people willing to sell. So when the WallStreetBets traders, or the traders on WallStreetBets, started buying this stock, you had very few stocks available and others were getting in, which meant that these short sellers had to try to buy at a higher price, and this continued, and you had a lot of funds losing money, one of which was a hedge fund owned by Citadel, Melvin Capital, and they had extensive losses and closed their trade recently. What happened following that is, in the recent couple of days, you had Robinhood, which, for those who are not aware, is a zero commission trading app, very popular with millennials and others, one of the largest stock trading apps in the world, and also well-known fintech. They decided to suspend traders from buying new GME stock, and this has led to a big revolt. This was already seen as a battle between Wall Street and these traders on social media, who felt they were part of the larger crowd and wanted to normalize the markets or bring justice to the market, or whatever it was. Incidentally, there is news that Robinhood has a significant portion of their revenues coming from Citadel, the owners of Melvin Corporation. There's a conflict of interest that comes into picture, but there's a lot of these elements coming in. So first, we saw GME go up. Now these Reddit traders, let's talk about that. The Reddit traders have started looking at other stocks that are being heavily shorted, and I believe that needs to be a market correction. So, for example, BlackBerry, right? Those of us who used the Blackberries 20 years ago or so, there's a revival now, and their stock has popped up. There are a bunch of others, such as AMC. AMC is into cinemas. And so Save AMC was trending on Twitter, and you saw a big spike up on AMC. In fact, they have now become they've lost, or their debt of 600 million has gone away because convertible debt owners decided to convert the debt at a certain price. So AMC is now in much better financial status. They raised more funding to continue going through the COVID crisis, so it's helped them. Whereas all the short sellers have probably been hurt quite badly, who are coming through from hedge funds and other financial institutions or large traders who often short the market. So yes, up and down, but very much not the norm. So you have the Securities and Exchange Commission in the US looking at it. You had the Congress talk about it, congressmen writing about it. You had Trevor Noah talk about it, CNN talk about it. Everybody wants to discuss this trade because it's almost like a new battle that's taking place in the United States with repercussions globally. Now, in addition to this, there are a couple of players that you can bring into play, right? Elon Musk, one of the richest men in the world now, owner of the world's most valuable automotive company, and also of a remarkable tech journey that he's had in terms of what he leads. Elon Musk's word is very strong among in social media and among his followers. It has a huge impact on markets such as the crypto markets. He said Dogecoin, it's one of his favorite coins as well. Recently, that coin jumped up 500% overnight, right? It's been around for 7 years. So it's not a new coin. It's just jumped up way against where Bitcoin went up 11%. This went up so much. Musk has just changed his Twitter handle to say Bitcoin. So we do expect now there will be a jump in Bitcoin. So this brings into picture influence of social media as well as of, whatever you want to call them, key influencers, and they are starting to have a big impact on potentially markets, how people look at markets, how they trade. So it'll be interesting to see whether regulators are going to start having oversight on this, what their response should be. All of this is legit. You do have a lot of people speaking on television, from CNN to CNBC, Bloomberg, Reuters, etc., who talk about what stock to buy, what stock not to buy. And here you have one of the richest men in the world telling about what he thinks is a good company or not. Similar to when he said jump to Signal after there was the issue with WhatsApp privacy. So you are having the likes of Elon Musk having a big influence, and people, maybe this battle is similar to thinking about how you had the likes of Warren Buffett for a long time, you talking about value investing and stock picking, to now speculative trading that a lot of people do, to social media influence trading. So we have seen the transition. Another example of short selling that has a big impact on the market was in 2008. I was a trader for the first 9 years of my career, and this was right in the middle of the global financial crisis. Volkswagen owned 75% or thereabouts of Porsche at that time. People had started selling automotive stocks as well, and in the German market, people were selling the Porsche stock. So coincidentally happened because there was very little float, in the sense number of available stocks of Porsche in the market. The short sellers got burned, and the value of Porsche went up significantly, and as a correspondingly impact, Volkswagen was for a brief moment the most valued company in the world, right, in a falling automotive market. So you can see that short selling does take place, but short selling squeeze can have a significant impact on many financial firms. So it'll be interesting how this battles go forward. Will we see new regulations coming in? Will we see anybody, normalization of that? And are we seeing the power switch from the likes of the Wall Street to traders who have had a lot more time in today's world under lockdown, etc., and doing a lot more trading on these robo-advisors and zero commission apps like Robinhood? And then lastly, conflict of interest. Can players like Robinhood, etc., who have decided to take some decisions for whatever reason, you had the founder of Robinhood coming in and talking about why they've done this, but all in all, there will always be these questions about, can they restrict market activity because of potential conflict of interest based on their clients? Used to happen previously, it's happening still now. So will people continue to believe in fintech companies, and how do companies build that governance, build their reputation, neutrality when you see such major moves happening? So stay tuned for FinStep Minute Stake going forward, and we will update you on the trends.